Please stand by. Good day and welcome to the webinar, The Crosshairs, Protecting Your Company Against Consumer Financial Protection Bureau Investigations and Investors' Mortgage Buyback Claims. Today's call is being recorded. At this time, I would like to turn the call over to Mr. Phil Stein from Bills & Sumberg. Please go ahead, sir.
Thank you. My name is Phil Stein. I am a partner at the law firm of Bills & Sumberg, and this is a program about defending against CFPB actions and mortgage buyback claims. Just a bit of background about me and about this program, and then we'll get right to it. I have a practice that is largely devoted to financial services litigation. I represent all different types of companies that are in the financial services industry and assist them with litigation and counseling, and also happen to do a lot of work for Homebuilder companies and Homebuilder affiliated companies. This was initially to be a program devoted exclusively to the Consumer Financial Protection Bureau, or the CFPB, and its attempts to increase its jurisdiction and get more actively involved in enforcement actions against a broader variety of subjects and targets. There was a lot of feedback to me when I announced this program that people would like to hear also about loan buyback claims, and so we're going to start the program with about 15 minutes or so devoted to loan buyback claims, kind of the current status of that type of claim and the defenses that are available to those claims. And then I'm going to devote the rest of the program to the Consumer Financial Protection Bureau and defenses related to the kinds of issues that it tends to raise against financial services companies. So starting briefly with the issue of loan buybacks, here's an overview of the current landscape. There really is still a steady flow of demands by the major banks, also known as investors, that loan originators or sellers, also known as correspondents, buy back mortgage loans. That's the bad news, I guess, for correspondents that are still facing a lot of those claims after all these years. The much better news is that there have been several recent notable court victories by correspondent lenders. A lot of them are based on the statute of limitations, and others based on more substantive defenses. But as we kind of thought all along, there are much better defenses available to correspondent lenders than they may initially think when they receive demands from the major banks or from Fannie Mae or from Freddie Mac. And that really has been proving to be the case as a lot of these lawsuits have matured and as decisions have come down in them. Certainly not all of them. There are some instances in which the major banks do prevail or get favorable settlements, but I would say there are a good bit more in which the defendants, that is the correspondent lenders, are prevailing and or getting very favorable settlements themselves to resolve litigation. The other thing that's really going on in terms of the current landscape for this type of claim is that there have been a number of recent major multi-billion-dollar settlements by some of the largest banks out there, notably Bank of America, Citibank, and Chase, among others, with the GSEs, that is Fannie Mae and Freddie Mac, and with other agencies. And those settlements, I believe, will likely spur even more demands as the major banks attempt to recoup their losses, attempt to recover money from the correspondent lenders so that the amounts that they paid out to Fannie or Freddie or the Department of Justice or other government agencies aren't a total wash for them. And so, unfortunately, as a consequence of that, it may be that these types of claims are still with us and will still be with us for some time to come, even though a lot of the loans that we're talking about are ones that were originated now 7, 8, 9, even 10 or more years ago. Talking a little bit more about the investor settlements or the big bank settlements with the agencies, here are the things that I think you need to know. First of all, it is the case that many investors have entered into settlements with Fannie, Freddie, and other government agencies to resolve claims, and those settlements are important for a number of reasons. But one of them that I wanted to emphasize to you is that if the investors paid mere pennies on the dollar, or 10 cents on the dollar, 20 cents on the dollar, to resolve the claims against them, that's a hugely important fact. The correspondent lenders should at least enjoy the same type of discount with regard to the claims against them. In other words, if your opponent, the major bank that's making demands against you as a correspondent lender, paid, say, 20 or 25 cents on the dollar to settle claims, if you think about it, that should really be the ceiling on the amount that the correspondent lender should ever be paying to the banks. The banks didn't suffer the full amount of the loss that they may nevertheless be seeking to recover from the correspondent lender. And so you want to pay a lot of attention, and I certainly have my clients pay a lot of attention with me to the amounts that are being paid by the banks as part of those settlements, because they really do limit and reduce the liability that correspondent lenders should ever have to the banks. Several of these settlements are also important due to major admissions that have been made by the big banks, Bank of America especially, but also Citibank, Chase, and others. Major admissions that I think are really helpful to correspondent lenders. It really enables them to turn the tables on the major banks, because you can't act in a court of law as if something that's out there in the public domain just doesn't even exist, except in very limited circumstances. So my point is that if a major bank has made admissions of things that it did wrong, or even fraud that it committed, it's very difficult for it to turn around and say with a straight face that it nevertheless was wronged by the correspondent lender, that it didn't do anything wrong itself. And so we're able to trap the major banks in a lot of those contradictions and use their admissions to our advantage. So what's been working for the loan originators, the correspondent lenders, in defending against and defeating the lawsuits that have been brought against them? Well, one thing is the statute of limitations. I can tell you that my clients have won 8 victories this year alone just based on the statute of limitations. Those are correspondent lenders and regional bank clients just in the last several months. And certainly other correspondent lenders not represented by me and my firm have won some statute of limitations victories as well. Another thing that's working for originators is simply fighting back harder than they may have initially felt empowered to do. I do think it's the case that originators almost always have stronger legal and factual defenses than they initially believe that they do when they get the repurchase demand. That's not to say that you should fight just for the sake of fighting, but if you believe that you've got strong defenses to a claim, you're probably right. There are probably good reasons for you to have that feeling, and with the work and assistance of a good attorney, you can generally raise those defenses successfully. Another thing that's working for originators is simply applying good old common sense standards to the claims. A repurchase or indemnification claim is a claim that's not really that different from all sorts of other cases that find their way into courts across the country every day. In other words, there are a lot of things that have to be proven in every case that also have to be proven by a plaintiff in a repurchase or make-whole case. So it's important to think about everyday kinds of litigation concepts, like whether the alleged defect really caused a loss, whether the alleged defect is really material, whether the contract is ambiguous, and whether the plaintiff, that is the bank that's suing you, has done what it was supposed to do to mitigate or reduce its damages. On a loan level, it also makes sense to focus your defenses on certain types of loans, certain types of claims. I find that pushing back especially hard on demands related to stated income loans or reduced documentation loans is, of course, a very successful or a very appropriate thing to do. Occupancy defects are another one that I think are particularly easy to defend because, as most of you in the audience probably know, all that was really required of you was to certify the borrower's intent to occupy as of the time of the loan application and as of the time of closing. You weren't required by any stretch of the imagination to ensure that the borrower then actually moved on to the property. Would have been a little silly for you to have that obligation. And so, just as a common sense matter, it becomes relatively easy to defend that kind of claim. Appraisal defects maybe are even easier to defend in most instances because unless there's some sort of fraud or total incompetence in the appraisal, generally speaking, we all know, and even the major banks have admitted at various times, that appraisals are simply opinions. And those opinions are not things that can be misrepresented the way that facts can be misrepresented. So given that an appraisal is just an opinion, it's difficult for a major bank or Fannie or Freddie to claim against a correspondent lender that the appraisal somehow caused their loss. And in certain instances, undisclosed borrower liabilities are things that give rise to very good defenses for correspondent lenders as well. Part of that goes back to the nature of the loan program. If we're talking about, say, no income, no asset loans where you didn't even know the borrower's income anyway, the undisclosed debt is generally not something that the plaintiff can say is very material because you couldn't really even do a debt-to-income ratio or debt-to-income analysis anyway. You don't know the borrower's income. Likewise with stated income. You weren't verifying the borrower's income, and therefore the undisclosed borrower liability probably wouldn't have had much impact on your underwriting in any case. And we often find that the so-called undisclosed liabilities are ones that were cleared up within a short period of time anyway, and therefore couldn't possibly have caused the loss that the plaintiff claims to have suffered years after the loan closed. The banks have an awfully hard time proving their claims, substantiating their claims on a loan level basis as well. Often when push comes to shove, it becomes pretty clear that they really don't have a lot of evidence to support their claim that there really is a defect, or they got their evidence in a really inappropriate, improper way. And often they even have a hard time demonstrating that they're the right party to be bringing the lawsuit or to be making the demand for buyback or indemnification on a correspondent lender. As we all know, a lot of these loans changed hands many times, and the scenario I always want my clients to avoid, of course, is a situation where we may agree finally to settle up, make some sort of settlement payment to the plaintiff, and then someone else kind of comes out of the woodwork and says, well, that's nice that you made a payment to that bank, but we're really the bank that holds this loan, and we're now going to make a repurchase demand. I don't let that happen to my clients, and you certainly shouldn't allow that to happen to you. You need to check, and you need to work with a good attorney to check whether the party that's making the demand on you even has the right to make that demand in the first place. I also think it's very important for originators not to act as though a buyback demand from Fannie or Freddie or one of the GSEs to the bank that purchased the loan from the correspondent lender is somehow automatically the correspondent lender's responsibility to contest. There are a number of good reasons that the GSE is writing to the big bank. One of those reasons is that the big bank is the entity that made independent representations and warranties about the quality of the loan and the accuracy of all the data in the loan file when it sold the loan. Or it might be receiving a letter because of something it did wrong in the servicing process, if your sale was servicing released. So it shouldn't be something that you see as your responsibility, certainly not automatically your responsibility, to respond to a demand made on the entity to which you sold the loan. Nevertheless, of course it's a good idea if you think there's kind of low-hanging fruit, something that you can easily rebut. If, for example, Fannie Mae has written to Chase and then Chase turns around and writes to you and you realize there's a very, very easy and appropriate way to set the record straight, sure, go ahead and provide that kind of information. It's not going to hurt you. But again, I don't want you to have the mindset that it's your responsibility always to respond to these just because, in my example, Chase asked you to respond to Fannie Mae's demand. Another thing that correspondent lenders have going for them are the admissions that your opponents have made at all sorts of times. I'm going to talk to you a little bit about some settlements and the admissions made in those settlement agreements. But even before that, long before mortgage repurchase litigation really even got going, the mega banks were taking positions in the press and in public documents, not to mention in their own lawsuits, that are inconsistent with the positions that they now assert against the originators. Just want to give you a few highlights. Bank of America, for example, the CEO of Bank of America said in an interview a few years ago that most of the disputed loans don't have the defects that people allege. Well, he was saying that in connection with claims made against Bank of America, but obviously it's the same loans, generally the same loan defect allegations that are made by Bank of America when it turns around and seeks to recoup its alleged losses. And so you can always throw back at Bank of America this statement by its CEO a few years ago. Another top executive at Bank of America noted, I think correctly, that the underlying reason for all the foreclosures that were going on was the broader economic downturn. As she said, the economy declined, unemployment went up, and house prices declined. That's not a reason for a loan to be put back, she said. This is back in 2010. Bank of America also made major settlement admissions as part of a $16.65 billion settlement with the Department of Justice. Some of those admissions are extremely helpful to correspondent lenders. And just to highlight them for you, at a very high level, some of the things that they admitted to were that they had so-called shadow guidelines that they didn't tell correspondent lenders about, but it was the so-called shadow guidelines that really determined in their minds whether a loan should be underwritten or not. And not surprisingly, those shadow guidelines were a lot looser and more flexible than their underwriting guidelines were in the relevant time period. And of course, those underwriting guidelines were pretty loose and pretty flexible as to many of the loan products that were out there to begin with. There was also a product that they referred to internally as Extreme All Day. So it wasn't just an all-day loan with a set of all-day loan requirements. They had what they called Extreme All Day, and essentially were granting all sorts of internal exceptions and allowing a lot of loans to be purchased and then resold or securitized, even though they didn't meet their guidelines for all-day loans. They also admitted to certain false representations that they made to their investors when they resold or securitized loans, and not that surprisingly also acknowledged that they had a tremendous increase in the number of so-called exception loans that they acquired in the years leading up to the major financial crisis. I don't want to belabor the point, but Bank of America certainly is not alone in terms of having made these kinds of admissions. Chase, Citi, and others certainly did as well. In my written materials, you'll see that there's also a very interesting admission by Chase's CEO back in 2010. The issues of causation and whether a plaintiff really did what it was supposed to mitigate or reduce its losses, along with statute of limitations and damages or lack of damages, are all issues, all defenses that give originators, in my view, a great deal of power to defend against and defeat high-stakes buyback demands. And so, though it's very frustrating to have to deal with these kinds of demands, certainly to have to deal with them still all these years after the loans were originated, I think there's a good basis for confidence, especially when you're working with competent counsel to defend against these kinds of demands. And you'll note in my written materials that I've got a couple of pages about the relatively new agency representation and warranty framework and how that changes things. I'm not going to go over that right now, but certainly feel free to take a look at that if you're not familiar with how the new framework has brought about some changes. Let's get into the topic of the Consumer Financial Protection Bureau, also known as the CFPB, and its jurisdiction and its enforcement activity as it becomes even more of, I think it's fair to say, an activist agency going after all sorts of players in the financial services industry. In terms of overview, first of all, no question about it, the CFPB really keeps claiming a greater and greater level of authority and a greater and greater level of jurisdiction over various players in the financial services industry. Its jurisdiction is wide and its reach seems to keep growing longer and longer. It's extended its supervisory jurisdiction to include credit bureau reporting agencies, debt collectors, student loan servicers, certainly residential mortgage companies, certainly they're getting more and more interested in auto finance companies as well, credit card issuers. You get the point. They're going after all sorts of companies and claiming greater and greater power over those companies. Now, in terms of the types of entities that are regulated, I gave you some of those. I think a key that I wanted to emphasize is that they have announced that they want to take much more of an activist role with regard to auto finance companies. And I know we've got some auto finance company representatives tuning in for this webinar. So let me just spend a couple minutes talking about some of the things that seem to be focal points for the CFPB with regard to your industry. The CFPB has specifically announced that it's preparing to launch in-depth reviews of about 40 large auto lenders. I don't think there's any reason to believe they will stop there, but they've already said about 40 large auto lenders will be scrutinized by it. The CFPB wants to determine whether those firms are following federal consumer protection laws, and their scrutiny is expected to lead to examinations as early as next year. Now, what are they going to look at? What are they going to do? First of all, the issues that seem to be of concern to them that are going to spur their actions are whether consumers are being steered into loans that they can't afford, whether they're being sold pricey add-on products whose total costs may not be clearly disclosed. Those are two of the big issues. Gaining supervisory power over non-bank lenders, such as auto finance companies, will allow the agency to do what? Well, to conduct rigorous, probably months-long examinations on site that could result in things like enforcement actions, civil litigation or regulatory actions, fines against the company, consumer refunds if violations of the law are found. The CFPB will likely do with auto finance companies what it's doing with mortgage companies and banks and other financial services industry players already. It will likely scrutinize several areas, including whether consumers are being steered into overly expensive loans that they're unable to repay, whether they're being placed in longer-term loans that reduce monthly payments but drive up the total cost of the loan, and whether the sale of add-on products are steering consumers wrong as well. In what could be a preview of the kind of actions the CFPB may be gearing up to bring, the agency last month slapped a subprime auto lender known as First Investors Financial Services Group with a $2.75 million fine to settle allegations that that lender had provided inaccurate information to credit reporting companies due to a flawed computer system. The company didn't admit or deny the allegations, but did pay that $2.75 million fine. Now, with regard to general activities of the CFPB, we're going to go into those in some detail in the remaining time, but understand that they can investigate violations of consumer financial laws through subpoenas, through what are called civil investigative demands. They can seek documents through subpoenas and those demands. They can require written responses. They can require reports. They can require testimony. And as I said earlier, they can conduct very lengthy, even months-long, on-site investigations. So this is nothing to dismiss the importance of. This is clearly something that merits your attention. Here again, as with buyback claims, though, I think, as we're going to talk about, there are means of protecting yourself, and I think that, while being compliant and civil up to a certain point, there are also opportunities to be aggressive and to push back with justification against overreaching investigations and bad theories by the CFPB. So we'll be talking about that a little bit more. Certainly litigation is one means of enforcement for the CFPB, and we will also talk a little bit about some examples of the kinds of results that the CFPB has been able to obtain either through settlements or from companies that haven't defended themselves very aggressively against the CFPB's claims. The bottom line for now is that the CFPB does have broad authority over numerous entities, both banks and non-banks, that are involved in offering consumer financial services or products. The CFPB is a young agency. It just came into being 3 years ago, and it's still in the process of defining its level of authority and applying it to the full range of entities that are potentially subject to its scrutiny or subject to its jurisdiction. But businesses involved in consumer financial services really do need to be familiar with the potential scope of the CFPB's authority and unfortunately need to be preparing for the very real possibility that the CFPB will want to launch an investigation or scrutinize its practices. There are certain laws that are unfortunately pretty vague and broad and far-reaching that are typically used by the CFPB as kind of the cover or the supposed basis for its claims or its threatened claims, its investigations. Fair lending laws are among the things most frequently cited by the CFPB when it does come knocking. Regulators, such as the CFPB, but other government agencies as well, can bring fair lending enforcement actions. And in theory, private consumer plaintiffs can as well, although they certainly don't do it as often, based on 3 different legal theories of lending-related discrimination. One is kind of the easy one that we won't spend a lot of time on, overt discrimination. A claim, rightly or wrongly, that there was just open, clear, plain discrimination based on race or gender or ethnicity or religion or sexual orientation or what have you, but open, clear discrimination. A second theory that gets a little cloudier and much harder to define is something called disparate treatment. And the third, that's kind of the scariest of all in terms of how broad and vague it can be, is something called disparate impact. We're going to talk more about disparate treatment and disparate impact since overt discrimination is a little bit easier to grasp. With regard to disparate treatment, there's no direct evidence in a disparate treatment claim that the lender intentionally treated similarly situated people differently on a prohibited basis. One of the things that's very annoying, frankly, about this type of claim is that the whole theory is that you, the lender, were not motivated by prejudice. You weren't motivated by a conscious intent to discriminate. But, nonetheless, even if it's not motivated by prejudice or a conscious intent to discriminate, the theory is that some sort of difference in treatment will be considered intentional if you don't have any kind of credible, non-discriminatory reason that you can provide to explain your policy or explain your practice. Disparate impact is even farther reaching and more troubling in a lot of ways than disparate impact. Disparate impact is more so than disparate treatment. Disparate impact is a claim based on evidence that a lender applied what everyone agrees was a neutral policy or a neutral practice that was applied fairly and evenly to all credit applicants. But nevertheless, the claim or the theory is that policy or practice resulted in a disproportionately adverse impact on members of a protected class or group without a proper business justification. So again, the idea is everyone agrees there's nothing wrong with your policy, there's nothing wrong with your practice, you didn't have any intention to discriminate, but gee, we look at the statistics, and unfortunately, we can make statistics say just about anything we want them to, and when I look at this set of statistics, it looks like you're favoring one group or class or type of customer over another group or class or type of customer, and I, the CFPB, want to dig into this a little more deeply. I want to just go through another one of the key laws here, and then we're going to talk about ways to kind of bolster your defenses against this kind of claim and prepare for investigations or scrutiny based on these kinds of claims in a little while. But the other major law, just so we get a sense of what the legal framework is, the other major law that we're focused on when the CFPB comes knocking is something called UDAP. UDAP is really the initials for unfair, deceptive, or abusive acts or practices. Those are acts or practices that are prohibited by the Dodd-Frank legislation that was very controversial in the aftermath of the great financial crisis. One of the things about UDAP that makes it very broad and very far-reaching and thus a favorite tool of the CFPB is that it's not limited to what are called larger participants in the marketplace. You can be a fairly small company and still be targeted under UDAP. Nor is it limited to industries that are clearly regulated industries. UDAP compliance is something that is a major concern of the CFPB, and UDAP is really a tool that the CFPB has seized upon to help it get what it wants. If it's got an agenda to be an even more active agency than it already has been in the 3 years that it's been around, UDAP is the way it can get to where it wants to go, because UDAP is pretty loose and broad and free-flowing. And if you look at the next bullet point on this slide, interpretation of UDAP is up to the CFPB in large part. That doesn't mean that the CFPB can't be reined in by a judge if necessary, but in the first instance, when the CFPB gets in an argument with you about whether there's some justification for it to investigate you, understand that the CFPB's claim is that it gets to interpret what UDAP, that is unfair, deceptive, or abusive acts or practices, really means. And so it gets to apply the rules as it sees fit. And you're really trying to focus on something that's a moving target. I just talked to you a little bit about fair lending laws and about UDAP, and I want to talk to you a little bit about how they interact with one another. UDAP is probably the most powerful tool that the CFPB has going for it, because really almost any practice could theoretically be attacked under the broad UDAP standards applied by the CFPB. Fair lending, therefore, becomes a powerful alternative. Disparate impact, one of the three theories that I talked about under fair lending laws, is something that is kind of questionable and maybe will get overturned by the Supreme Court if a disparate impact case makes its way up there. A couple of them, by the way, have gone to the Supreme Court, but they got settled by the parties before arguments in front of the Supreme Court, and thus there was no ruling. Anyway, disparate impact analysis is a powerful alternative, it can be used to attack practices that, even if they don't arguably violate UDAP, which is so broad to begin with, arguably have a disparate impact on protected classes. Now let's talk a little bit more about UDAP and why it's a real menace and something that we need to protect ourselves against. UDAP is a vague statute, and you can take it straight from the horse's mouth. The CFPB director, Richard Cordray, gave some testimony in February of 2013 at a hearing, and he talked about, just kind of off the top of his head, several of the many, many examples of things that might violate UDAP. And you see how broad and almost limitless, as he says, the possibilities are for injuring consumers in the mind of the director of the CFPB. UDAP, as I said, has to do with unfairness, deceptive activity, and abusive acts or practices. So if you think about unfairness, deceptiveness, and abusiveness as three prongs, we can go through each of them, and I can tell you what we do know based on precedents that are out there so far seem to qualify under each of those prongs. For unfairness, the key ideas seem to be that the action or the practice or the policy is something that causes or is likely to cause substantial injury to consumers. It has to be something that relates to an injury that's not reasonably avoidable by consumers, and it's got to be the type of injury that isn't outweighed by benefits that consumers receive or benefits to competition. And, as a defense lawyer, I can tell you that this does give me and my clients some real opportunities to argue that, the CFPB is really barking up the wrong tree. You can talk about how the injury either didn't happen at all, or it was one that was something that consumers could avoid, or something that's outweighed in any case by all the benefits to competition or all the benefits to consumers generally. Nevertheless, there are some things that we need to bear in mind with regard to the unfairness standard. You have to bear in mind that when we're talking about what kind of monetary harm, what kind of financial injury was suffered as a consequence of the supposed bad action, an act or practice that causes a small amount of harm, but causes that small amount of harm to a large number of people, is considered by the CFPB to satisfy that requirement I told you about, that there has to be a substantial injury. And then it gets worse than that, because according to the CFPB, actual injury isn't even required. Just a significant risk of concrete harm is sufficient. Now, let me take a step back and remind you, we're talking about what the CFPB thinks. And one of the things that, as an aggressive lawyer, I want to make sure everyone's aware of when I'm involved in a case like this is that the CFPB, for all its power and authority, does not get to be judge, jury, and executioner. And you need to be defended by someone who recognizes that the CFPB is not those things, and though it may have these views and may want to keep investigating you based on these views that it has, if you do ultimately have to go to court, if you do have to go in front of a judge on these kinds of issues, or an arbitrator or whomever, you are going to get an opportunity to push back and show that there really wasn't any injury, there wasn't any major risk of injury, and the CFPB was just being, way too activist and way too aggressive. Let's talk about the deceptive standard that's part of UDAP. Here, we have to be talking about something, according to the CFPB, that misleads or is likely to mislead the consumer. The consumer's interpretation has to be one that's reasonable. So, you could be misled, but you're misled by your own unreasonable view, and even the CFPB realizes that that's not the lender's fault. And the misleading representation or omission has to be something that's really material, meaning it really has to have a significant effect on, the ultimate problem. Abusiveness is the final part of UDAP. And what we know from the CFPB's guidance and from case law about what abusiveness really means in this context is that it is pretty broad, but we know it has to be something that materially interferes with the ability of a consumer to understand a term or condition of a product or service. There has to be some concept here that the policy or the practice or the marketing materials or whatever took unreasonable advantage of a consumer's lack of understanding of the issues, or took unreasonable advantage of the consumer's inability to protect his or her interests in selecting or using the product or service. Well, it's scary, though, because no rules further define beyond that what abusiveness really is under this act, under this law. And that director I told you about, CFPB Director Cordray, said, and I quote, "I'll know it when I see it." Well, I know that doesn't reassure you about, the good faith of the CFPB, but it does, tell you need to get your antenna up in preparing to combat these kinds of allegations and investigations based on these allegations. What's the role of consumer complaints under UDAP, or in terms of how often consumer complaints lead to investigations or scrutiny by the CFPB? Well, the CFPB admits that consumer complaints really do play a key role. The CFPB believes that at a minimum, consumer complaints may be good indications of weaknesses in a lender's compliance management system or a lender's training or internal controls or monitoring. And one of the things that this strongly suggests to me is that companies who may face the wrath of the CFPB should really track the categories of complaints that are being reported, and I really mean two different types of complaints. First of all, of course, you've got to be keeping track of consumer complaints that you're aware of directed to your company. But there's also an opportunity to have somebody in your office or some lawyer you're working with to periodically check what seem to be the major categories of complaints that anyone out there, not even talking about your company, anyone out there is complaining about to the CFPB. If you get a sense of what it is that consumers are most likely to complain about, and I know we probably all feel as though we've got some sense of what it is consumers are most likely to complain about anyway, but if you can get a specific sense from the data that the CFPB publishes, because it does publish it, you can probably help to modify or structure your own practices and policies to at least make sure you're lessening the chance that someone's going to complain about that with regard to your company. Now, let me give you a few examples. I'm not trying to scare you, and again, I don't know that the defendants in these cases, which I was not involved in, defended themselves as vigorously and aggressively as they could have, and often they, in fact, settled very quickly. But here are some examples of cases that should put you on real notice about the power of the CFPB and the kinds of results that it can get from making some of the claims that it makes. In the Southern District of Florida in May of 2013, the CFPB launched its first enforcement action against anyone that related to so-called abusive practices under that UDAP Act. Within a week, they'd gotten a settlement and final order. Obviously, the defendant ended up settling with them. And what they got as part of the final order were things that included a ban on that company's debt relief products and services, close to $500,000 in penalties and damages, another $15,000 civil money penalty, and the defendant wasn't even out of the woods because even after all that, it was going to face 2 more years of intense compliance monitoring by the CFPB and reporting by another agency. The CFPB has been hard on debt collection companies, and companies playing other roles in the financial services industry, shouldn't think that this is just unique to debt collectors, but, again, there are interesting precedents to consider. In the Central District of California, that's in the Los Angeles area, even though I know Los Angeles isn't really in the Central District, that's what it is for court purposes, the CFPB obtained a TRO, a temporary restraining order, freezing defendants' assets and appointing a temporary receiver. The complaint in that case alleged, among other things, that defendants had deceived consumers, and so we're really going under the deception part of UDAP in that case. The CFPB itself does not have the authority to take criminal actions or seek criminal penalties, but it gets around that by working with the Department of Justice, which does have the authority to initiate criminal proceedings when the CFPB thinks that a criminal referral is appropriate. So we had an example in the New York area back in 2013 in which the CFPB did tag team with the Department of Justice against a settlement company. There was a civil enforcement action, that is a civil suit, by the CFPB and a simultaneous criminal indictment by the U.S. Attorney, who was part of the Department of Justice. a debt relief company, its president and 3 employees were charged with mail fraud, wire fraud, and conspiracy. So it can happen. You can get a civil criminal 1-2 punch. So how do we manage all these risks? Now that I've scared you, let's talk about fair lending and UDAP-related risk management. That is, risk management against the kinds of things that the CFPB seems to be most interested in policing. One of the ways that we can all get our heads around what it is that we need to do is to take a look at what's happened in some of the major settlements and some of the major enforcement actions, some of which are well publicized, that the CFPB has taken on. And if you don't feel like you've got easy access to these kinds of materials, work with me or work with some other attorney who can get you this kind of information. But here are some of the common themes, or I'll call them tipping points, that tend to spur allegations or spur investigations by the CFPB. One of the things that they seem to really not like, and so it's a common theme for them, is that your employees had broad discretion, your loan officers or whomever had broad discretion in dealing with consumers, and that's all well and good, but the CFPB says that that broad discretion supposedly resulted in a disparate impact. And so ultimately, despite your very neutral policies, your fair and even-handed policies and practices and procedures, certain types of consumers are much less likely to get a loan or a particular type of product or a particular type of service than other classes or groups of customers. Another thing that seems to get the CFPB all up in arms is a lack of clear policies or a lack of clear controls, internal controls, governing the exercise of discretion. And let me stop there and tell you that one of the things that I want my clients to do, and I want you to do, is to think about treating discretion almost the way you would treat an exception. In other words, if someone is using his or her professional judgment and discretion in a way that is not strictly by the book and reaching certain conclusions that are very discretionary, it's not to say that someone can't do that. I'm not saying that, but let's at least document that more often than we're probably doing right now. Let's document what it was that kind of tipped the scales in your employee's mind in favor of one course of action instead of another. Why did we decide not to make a loan to this consumer? Why did we decide to make a loan to this consumer? What was different between the two when everything else on paper seemed to be pretty much the same? Why did we reach a different result? Just jotting something down, putting something in writing in real time that explains, your good faith reason for doing what you did is something that's going to serve you very well if the CFPB does, in fact, come knocking. And that really bleeds into my next issue, which is little or no documentation of the business rationale for discretionary pricing adjustments. When there is little or no documentation, that's another tipping point. That's another thing that seems to set the CFPB off. Financial incentives for loan originators to charge higher rates or fees, or financial incentives for them to steer borrowers to higher cost products. That too is a common theme, something that gets the CFPB motivated to take action. The CFPB, it's pretty clear, has certain expectations with regard to the kinds of systems that companies should have in place to be monitoring and tracking and being careful about how they're doing business. And I think there is common sense recognition that some companies are bigger than others. Not all companies have boards of directors or the same number of on-site managers. But generally speaking, what the CFPB seems to be expecting and looking for is that you're going to have these components to your kind of compliance management. One is that there is board or senior management oversight, and that really means involvement in the entire process. If you think about a particular policy or procedure, the process I'm referring to, the creation of that policy or procedure, implementation of that policy or procedure, and review as to how that policy or procedure is working out. Again, we want board members and managers to have periodic involvement in every step of that process, those 3 major phases. There need to be compliance programs, and those certainly can be outsourced. Probably it makes the most sense to do that with lawyers because these are really legal issues as to what seems to violate these laws that the CFPB claims to be enforcing. Compliance programs can be outsourced, but if you have a compliance officer, you want that compliance officer or the people doing the compliance to be independent of the key business lines. You don't want them to be really taking their directions from people who, let's face it, are much more interested in just making sure the volume of sales stays high. You do need some independence there. A compliance program needs to have well-defined policies. There needs to be a meaningful training component. There needs to be meaningful monitoring of what's going on. And you need to be taking corrective action when things don't work out in a particular instance, when something does violate the policies or is not the best practice or the optimal procedure. You need to have a consumer complaint management program. In other words, you need to be tracking complaints made by consumers. You need to have some kind of systematic way of following up, both with your people and with the consumer, to make sure things don't mushroom out of control. And there need to be compliance audits, and those audits need to be independent of the compliance and business functions. So here we're talking about maybe you've got a compliance officer, but you don't want the compliance officer to be auditing how the compliance officer is doing or how the compliance program is working. You do need someone outside or independent of compliance and business functions to kind of check up on the compliance program and the compliance officer and give some thumbs up or thumbs down feedback as to how things are working. Some of the things that it's good to be ready with, in other words, things that you need to have out there and ready if the CFPB wants to come in and do an examination, are things like written training materials, meaningful disclosures and notices and agreements and account statements, the kinds of things that show that you're not doing things in kind of a fly-by-night, seat-of-your-pants way. You do have regular kind of official disclosures and notices to consumers and agreements that are, also systematic and form agreements. You need to have procedure manuals and written policies, including those related to, servicing and collections. To the extent you have a board and board committees, definitely need to have minutes of board and committee meetings. And it would be particularly helpful if, as part of those board and committee meeting minutes, there's at least some section, at least, maybe a couple times a year, if not more, devoted to compliance-related issues. Internal control monitoring and auditing materials. If you're going to have an auditing program, you need to have written evidence, I guess, that there is that program and something explaining what it entails and what's been done under the program. And I've listed on the following pages some additional things that are typically reviewed as part of a CFPB UDAP examination. I'll just highlight a couple of them. Scripts for telemarketing and collections. I've got clients who call me and say, can you just take a quick look at these marketing materials, just make sure that nothing here in our advertising seems to violate rules and requirements related to fair lending or fair business practices. That's one thing I wanted to highlight for you on this page. Another thing is compensation arrangements and incentive programs. Again, a real warning signal to the CFPB seems to be when your employees or some of your sales staff are encouraged to try to get to a certain place in terms of the yield or the spread on loans, the interest rate, and are being incentivized to steer customers to one type of product rather than another, or steer a particular type of customer to a particular type of product. And then finally, I would just say that we can learn a lot from settlement orders related to the actions that the CFPB and the Department of Justice have taken against financial services industry companies. There are important lessons in those settlement orders about what the scope of liability might be, what your financial exposure might be. And often the news, frankly, isn't very good, which just, emphasizes again how important it is to be prepared on these issues, to work with a good attorney on these issues, and, be ready to combat the CFPB in an appropriate way when the CFPB comes knocking, if in fact it does. Some of the things we learned from settlement orders are that potential liability can extend back several years. In fact, as far back as 2004 in some recent cases. Investigations can be spawned just from a statistical disparity in a single geographic area or from a consumer complaint or consumer interest group study alleging discrimination. And when I talk about a single geographic area, I mean you could be a company that's operating in many states, and yet the CFPB could, at least in theory, and has on occasion said, well, yeah, we agree in 15 of the 16 states where you operate, there doesn't seem to be any problem. But over there in western Michigan, we're a little troubled by the way things seem to be happening, and we don't like some of the statistics. So, not to make you paranoid, but you do need to be aware if you're a multi-state, multi-office kind of operation. You do need to be aware, even more probably than you always have been, of what's going on in your various offices from a lending policy and lending outcome kind of standpoint. Lenders can face potential liability for the actions of third parties. So a residential mortgage correspondent lender might face liability for actions of a mortgage broker. I've listed an example of a consumer protection enforcement action from May of 2013, and this one shows that the CFPB will scrutinize joint venture arrangements on occasion to see if it believes that those arrangements are substantive or whether they're a sham. Again, the point here is that the CFPB really is poking its nose into all sorts of aspects of companies' businesses. Finally, I would just say that the implications of settlement provisions for fair lending risk management are that we know that the terms of regulatory settlements with companies who've already been attacked by the CFPB, do tend over time to set expectations. And so if the CFPB is saying in a settlement with a major financial services industry player that it expects that player to do X, Y, and Z in the next few years, you need to be working with somebody who can point that out to you and say, if you're in that same industry, looks like the CFPB really is very interested in making sure that X, Y, and Z are happening in our business, and you can adjust accordingly. We know that you do need to review, revise, and monitor your policies, especially with respect to product offerings and pricing outcomes. I mentioned earlier that, not that you can't use discretion. Obviously, we all need to use discretion and professional judgment in our day-to-day lives, our day-to-day careers, but I think a best practice would be to control, manage, and monitor discretion, and as I said before, document important uses of discretion. If something wasn't a slam dunk one way or the other and you took a position that maybe was a little bit controversial, while it's fresh in your mind, let's get there and document why this was done so that you have a record for all time of what exactly was done and your good faith reasons for doing it. Manage discretionary pricing as you would exceptions, whether or not they're considered policy exceptions, and document, as I said, your business justifications, for example, your underwriting decisions, and maybe for changes in policy as well. That's all I have for now. If I can be of any further assistance with these issues, I've given you my phone contact information, my direct dial in the written materials, and if you have any questions for me now, I'm happy to take them. Thank you.
Ladies and gentlemen, that is all the time we have today. Phil will take your questions via email. This concludes today's conference call. Thank you for participating in the Crosshairs Protecting Your Company Against Consumer Financial Protection Bureau Investigations and Investors Mortgage Buyback Claims webcast.